Hello, everyone. Welcome to another edition of Let's Talk Tax. Today's edition is a little different. We're going to do a little post-election predictions, if you will, on what's going on in Capitol Hill with related tax legislation. Today, I'm delighted to be joined by my partners, Dave McGuire and Jerry Hammel. Welcome, Dave and Jerry.
Morning, TJ.
Nice to see you.
So today's edition is also a little new platform for us. We're not in the same room as this is a busy time of year, so we're in different areas across the country. So I appreciate Dave and Jerry taking time to talk, obviously, about these important issues as we enter another year-end tax planning season as we look to 2025, and obviously another busy season that starts here in January. So I'll kind of kick it off with you, Dave, in terms of after last week's election. I know that we know who President-elect Trump's going to be in the White House, obviously. The Senate's going to be under Republican control. The House is still uncertain, but looks like it's slanting towards Republicans. What are your general feelings and predictions regarding some of the tax legislation we're going to see in 2025 as the TCJA provisions expire?
I think we've seen a lot of promises on the campaign trail. It's what comes to fruition and what can be done quickly is, first off, the president's going to have broad authority over tariffs. So if Trump wants to do that, he will not need Congress to come on his side for most of the tariffs that he's proposing. Now, when it comes to tax legislation, that's where we're going to need a much larger congressional approval. The issue is going to happen is that the Senate is not going to have the filibuster-proof majority. So anything that's going to pass has to be through the Byrd Rule, which means it has a 10-year limit on how it can affect the federal deficit, and they will put limits on the cost of it, just similar to the TCJA, where they said after 10 years it cannot cause budget deficits, but even during the TCJA, that 10-year period, they set a $1.5 trillion cap. Something similar is going to happen as they push any tax bill through. So we're not going to see some permanent changes on a lot of things. Mostly what we're going to see is temporary, and I'll call it TCJA number 2, which most likely will look very similar to TCJA number 1.
Jerry, in terms of looking at the key, obviously your background and decades of public accounting and advising clients, how do you typically approach a time like this, or how do you advise some of our alliance firms and clients to look at this when you're in a lame duck session getting ready for a new Congress with a new president, even though it's not a new president, it's a president we're already familiar with from a previous administration?
Yeah, good question, TJ. I think there's been so much uncertainty and so many changes over the last couple of years. Actually, it's been really difficult to plan. 174 was going to be corrected. Now it's not. Now it is. It went back and forth. So I think number one, what I worked with my clients, making good economic decisions for their business. I said, regardless of the tax, don't chase the tax, but look at the economies, look where you need to invest, shore your business up, and then make tax effective decisions. But going into this year, I think it's still going to be. I would still plan for individual rates staying the same. I would look at accelerating deductions, deferring income if I could. I don't think they're going to go down. They've talked about extending QBI, which we have through 2025 anyway. So I don't know that there's any radical changes. So I think the old tried and true tax planning at the end of the year really still holds true.
So you don't think we're going to completely remove the income tax burden and move it to tariffs, as some have stated?
Well, Dave, that's interesting. You made the comment that Trump has a unilateral right to adopt tariffs or implement tariffs, but to eliminate the income tax code, he's going to need all three parts. The House, the Senate, and the White House. So that, I think, is going to be a bigger hurdle. And it's such a monumental change. I certainly don't see that happening anytime soon or rapidly.
No, I completely agree. I think there've been promises that I've actually, as TJ mentioned, I'm out of town today at a conference, and there have been people talking about that. And the odds are it's too expensive, number one. Tariffs are not going to make up the loss of revenue if you got away from income tax. Now, I mean, we've been hearing about the idea of a consumption tax for years. I think, was it Steve Forbes that originally started really pushing it on campaign trails probably 20, 30 years ago. But it never really got too much traction because it would be a regressive tax to push, because that's what increasing tariffs and trying to replace the income tax would be, is a de facto consumption tax on individuals. And I don't see the ability to get that through three branches of government.
I don't think the Republicans have, at least in Congress, have that. There's that many of them that have the stomach for that either. I think that's more of that would be a pretty significant shift in policy. And I don't see, I see the challenges that we had in passing, the tax bill earlier this year, HR 7024. I just do not see the Republicans in the Senate, especially, having the stomach for such large change or a large shift in how we tax and how we generate revenue.
Yeah, I completely agree.
I would agree.
Dave, in terms of, obviously we talk a lot, one of our cornerstone practices is our fixed asset practice, which is our cost segregation. How do you advise, with bonus, obviously always seems always fluctuating or a state of flux, how do we advise clients right now that are building buildings or buying buildings and looking at, should I wait? Should I do a study now? What's your advice, knowing that bonus depreciation will probably be impacted by to quote you, TCJA 2.0?
The fact of the matter is it will affect a bonus depreciation, but doesn't affect how we do the study, and it does not affect any of the assets. So for example, if you're building a building and you completed it in 2024, you've got the deductions out there. Whether they pass this or not, you're going to get the same amount of deductions, so you might as well maximize them. Waiting on them doesn't change anything. If we see that we think a tax bill is going to pass early in 2025 and bonus depreciation would be retroactive to 1/1/2025, then you can get people playing with placed in service dates where maybe I extend this building into 2025. The problem is that can backfire. If they wait a year, you could be losing out on 60% bonus depreciation in 24 and having it leveraged down to 40% in 25. And if they don't make the bill retroactive, then that could affect you. So my recommendation is you maximize the deductions when you can take them, because you know what your tax rates are, you know where you can get them, so maximize them. Actually, speaking at this conference, I've talked to a couple people today who are looking to maximize deduction to maximize cash flow because they've got imports coming in. And they're concerned about tariffs increasing the price of their imports, so what they're trying to do is maximize their cash in hand right now so they can pre-order goods before any tariffs would come into effect, so that they can have more time to adjust to them with their consumer base if they've got 6 months of working inventory at all.
And sticking along in our fixed asset practice, Dave, is that what are you seeing? Obviously there's a big shift with, a couple of years ago with 179D and 45L. 45L has changed drastically given the fact that now these buildings have to be Energy Star certified. But 179D is still a tremendous tax planning tool for CPAs and their clients.
Correct. 79D, just to give the basic overview, it went from $1.80 a square foot to $1 a square foot. However, it can go up to $5 a square foot, indexed for inflation, so it's $5.60 and some change right now, if you pay prevailing wages. Additionally, the other benefit of it is it can be transferred from the person that owns the building back to the designer in the case of government or tax-exempt entity projects. So if you have an architecture firm that designs a school, whether it be public or private, the school can transfer the deduction back to the architecture firm, and they can take that deduction without having to reduce basis in their asset. Now, one of the key questions is going to be, do they do something about the prevailing wage provisions? Obviously, the incoming Republicans were not a big fan of some of the Inflation Reduction Act provisions. One of the big things that the Inflation Reduction Act put in place was prevailing wage requirements and apprenticeship requirements behind some of these things. Do they do away with that and bump everything up to $5, or do they keep that in place? These are some of the questions we won't really know till we get a draft of some of the tax bills that they might be looking at.
Dave, and I think, one of the things that Republicans have stated that making TCJA changes or those expiring provisions, making them permanent. So I hear what you're saying about the Inflation Reduction Act, and maybe they tinker with it and change some of those provisions they weren't happy with. But I would say that's probably second tier agenda items for them. I think they're going to come out of the gate entirely focused on TCJA.
I would agree. The question will be is, can they make it permanent under the Byrd Rule, and what's the requirement? Now, the benefit that they have is they're going in with the corporate rate, which is one of the most expensive parts of the original TCJA. The corporate rate's already permanent. But now switching 174, which is now a temporary provision, getting individual tax rates lowered. There was a statement, obviously, if they push forward on the no tax on tips or no tax on overtime, those are expensive provisions. How do they get all these things in and still have the bill come under the Byrd Rule where it doesn't affect deficits after 10 years unless they do away with the filibuster, which there is a chance of that, but I think that has a whipsaw effect that they're not going to want to open that door if they don't have.
Yeah. And Dave, I think I stated that was the Republicans' objectives, but I think you're right. The challenge is going to be to balance this out and make it tax neutral, make it cash neutral. And I just don't think they'll be able to do that because I really, as I think about it and reflect on it, I don't know where the pay-fors are going to be. Okay, what we see is the wish list of we want, but y'all know nothing is free. So where are the pay-fors? And I think that's going to be the interesting dynamic in the negotiations is where they target the revenue enhancers, to make this neutral.
And that's the question. I mean, obviously, questions like the Department of Education and other areas, internal departments, but even that doesn't make up enough of the, I think I saw a stat yesterday that it's only about 15% of the federal budget is salaries for federal employees. So even if they fired every single federal employee, it couldn't pay for some of the programs. So all the cost cutting that they're looking to do, that's going to be difficult to do. And I don't know that it offsets, as you said, the pay-fors in this bill that they're looking for. They're going to have to find some other ways to raise revenue. Last time they did things with the salt cap. Well, now they're saying they want to bring the salt cap back, get rid of the salt cap again. You can't have everything if you're going to have those pay-fors.
One thing that's really dominated our discussions over the past 2 years is 174. As Jerry, you mentioned a little bit ago, we were promised, for years that it was going to get fixed. We were promised in the end of 22 it was going to get fixed. We were dangled this carrot throughout 23 and even into 24. What is the general consensus you both have on 174 regarding this new tax legislation? My question is I personally believe that 174 amortization is here for the 24 tax year. I don't think it's going to change before 25 at the earliest. What are your all general thoughts on 174? Is there a chance it gets fixed for the 24 year, or is it here to stay and it'll be maybe addressed for the 25 tax year?
Yeah, I think I agree with you. Is there a chance? There's always a chance. You can't rule that out. But I think it's very slim that it gets addressed for 2024. I think they're going to focus on 2025, and I think that message was sent loud and clear in June when the Senate couldn't get on board with the House bill. And so I don't see them going retroactive to 24. I think they're going to focus on 2025, and I think they have a challenge. They've got this wish list, but they're going to have to come up with pay-fors to make it cash neutral. So I think that's where the negotiations are. So I don't see them looking backwards. I do see, I see maybe some alternatives in the 174 area, like maybe they have a large corp, small corporation definition. So that could be a way. It's not really a pay for, but it's not as expensive then if you did it for small companies. I don't know the number, less than 500 million in revenue. They'll have to define that. But I think 174 is going to be at the top of the list. I think bonus is going to be at the top of the list. After that, I think it's a free-for-all. I really don't know.
For our listeners, McGuire Sponsel has been very active with an entity that's has hired DC lobbyists over the past year plus. And so we have had a lot of dialogue with elected representatives and those individuals that sit in DC that are talking to our elected representatives. And it just never seemed that there was great interest, especially by Senate Republicans, to deal with this on a temporary basis. They wanted to build the 174 correction into a large tax the larger tax bill in the 25 calendar year.
And as I would agree with both those statements, and to add to what Jerry said, yes, I don't think this is getting picked up right away, but worst case scenario, we plan on it getting picked up right away, and we see what happens as it moves forward. And worst case scenario, you're going back and saying, you know what, all that 174 planning that we did, we don't need it, but it's better than the alternative of having to do it at the last minute. But back to Jerry's point, we need the pay-fors. And unfortunately, 174, that's part of the reason we're dealing with it now. It was a pay-for, in the original bill that now we're dealing with today. So where are those areas that they're going to have to utilize it moving forward?
And TJ, you mentioned the lobbying group that we've been interactive with for, oh my gosh, at least 18 months, trying to stay in touch with this, with the traction on this and just the latest. And I think this summer when we talked, they had actually, I think that it was the House that had set up a subcommittee for each provision of TCJA. Yes. Now, this has been a long campaigning season, so I don't know how much work that those subcommittees actually accomplished, this fall, late summer and fall. But it'll be interesting to see. I think we'll be able to see how much they accomplished and where they're at as they head into, January, February 2025, and how quickly negotiations proceed. Because if they got a lot of work done, if they've had some conversation to have a framework, that should accelerate some of the action to get it to a bill, I think, in 2025.
I think there's going to be a lot of pressure on the Republican Party in both chambers to act quickly and not let this drag on. You have a majority, even though it's not a significant majority. You're on the clock, and I think that's the reality is that there's going to have to be quick action. I think President-elect Trump is going to demand quick action, and so it'll be interesting to see how they prioritize things. Obviously, the border is going to be up there. Obviously, anything economic related. Obviously, anything with oil is going to be up there, but it'll be interesting to see what he deals with in executive orders and what's he pushed to Congress and saying, hey, legislatively, this is what we need to move quickly.
Yeah, I agree. And you mentioned the border. I mean, there's another cost, right? So I think, all of these things are costs. I think probably in my mind, and I don't have anything to base this on, but freeing up oil, doing some of the things that Trump campaigned on, I firmly believe that they're going to try to project a larger economy, higher growth rate, and so the rate, that's probably going to be some of their projections in the pay for. If they're allowed to do that, is show more profitable companies and therefore raising the tax amount paid, even though the tax rate maybe stays the same.
Jerry, another point that you brought up was QBI. And whenever I hear QBI, I think of our IC disc practice, because that has a significant bearing on our clients that have a disc structure. Could you kind of walk through just a little bit of what the disc opportunity that still exists? Obviously, 10, 12 years ago, the tax arbitrage was much larger than it is now, but it's still a very valuable tax planning tool for those companies, especially if you think about what they've been discussing, bringing jobs back in domestically, maybe increasing exports. Could you kind of walk through that real quick for us?
Yeah, I will. And maybe before I jump into that, TJ, I'll also point out that one of the campaign promises from Trump or ideas were that if you had U.S. companies that brought jobs back and manufactured in the U.S., they would lower that corporate rate, the C corporation rate, to 15% for those entities. So I don't know how you'd prove it. I don't know, how you'd validate that to get that rate. But anyway, it's more of a concept. But I wanted to, since we're talking tax rates, I want to talk about that first. With exports currently, the arbitrage, and for a flow-through entity that owns a disc on their exports, that income that gets taxed, you're basically shifting it from ordinary income to qualified dividend rates. So that difference in arbitrage right now is about 5.8%. So you've got to have a higher amount of exports for that to be cost justified. By the time you pay for the project, pay the fees, and then measure the benefit. If QBI is allowed to lapse and expire, that arbitrage goes to 12.6%. So it's going to be a much more significant arbitrage. So it'll make those exporters that already have a disc that are enjoying the 5.8, they'll get an immediate tax savings and a bump on the same amount of exports. Those that maybe were on the fence, right on the bubble of whether it made sense to do a disc, we need to take another look at those, because now you can probably get in and it'll be benefit to cost ratio that makes sense at that, say, $1 million, $1.5 million range, depending on how profitable they are.
Gentlemen, is there any other matters that come to mind when you think about tax policy for the 25 calendar year and helping our clients with the 24-year tax year planning?
No, I mean, I think one of the main things is going to be that we need to, and Jerry said this earlier, and we've reiterated it, we need to move forward with the tax laws as they are and create some urgency that, look, just sitting back and waiting doesn't make things change. So we need to move forward with the way they are and start doing the planning for 24 as if it's not going to change, and then we'll see. The first 100 days is really going to let us know what the priorities are, whether it's going to be the tax border, as Jerry kind of went through. There's a number of different provisions that they've talked about. We will know probably by the end of January, early February, what the timeline looks like, but we should start the planning for 24 today.
And TJ, I would think, we talked about a few things. I think Dave mentioned, these aren't high on the radar, but I think it's worth mentioning. Dave talked about, no tax on tips, those provisions, and actually both sides were throwing that out. But I also think a couple significant smaller items for individuals are, exempting Social Security income from taxation. Currently, it's taxable depending on your other income and your AGI. So that's out there, could help seniors. And then the other one is just where the estate tax goes. I know there's a lot of planning there. Generationally, we have a lot of companies that have matured to the level where they're being passed on to second or third generation now. There's a significant shift in our age population. And so that's a significant part of a lot of the CPA firms planning that we work with. And I think where that estate tax level is, that's going to be something that'll be a key planning aspect as well. They've thrown out the elimination of the estate tax. And, candidly, I don't know if that will happen. I think it'll stay, but it doesn't bring in a lot of dollars anyway. But it would be, again, back to our earlier conversation, it'd be one more additional cost. And so I don't know how much of a priority is. I would think they would just maintain, and again, I agree with Dave McGuire, the temporary nature of a lot of these changes. I really don't see how they're going to make a lot of things permanent, even though they want to, because they don't truly have a majority where they can get a tax bill through.
Unless they completely get rid of the filibuster, I would agree, which that will have a whipsaw that they don't probably want to open. I know McConnell's been one of the main advocates of keeping it, but McConnell's going to be out. So there's a question of how that works. And Jerry, you mentioned the no tax on tips. We also have the potential of the no tax on overtime if they really push that. And what does that do? That's another cost. But also, if they do implement it, what does it look like? What are the definitions behind it? And are there opportunities for tax planning around that? Whether it be, do they change the overtime rules to be 160 hours a month versus 40 hours a week, which has been proposed? Do they have a limitation on income for tax on overtime? There's a number of questions that come into play when you start pushing for new policies that are completely new like that. What are they going to actually look like in paper?
And Dave, the one thing I went back to the filibuster. I completely agree with you that I really doubt that they eliminate that. And the reasoning why is that no party has stayed in control throughout the history of our country. It swings back and forth depending on trends and momentum. And I just don't think, I personally wouldn't want to put that in the hands of the other party when they're in control. I think it'd be a dangerous precedent. And I really don't see that being eliminated just because of that reason.
Dave, Jerry, thank you both for your insights during this edition of Let's Talk Tax. As always, to our listeners, if there's ever a question how we can assist you all or answer any questions, don't hesitate to contact me or Dave McGuire or Jerry Hammel. We really appreciate your time today, and we look forward to serving you in the future. Take care.
Thank you, TJ.
Thank you.
Thanks for tuning in. Remember to subscribe to Let's Talk Tax podcast channel on YouTube to be notified and receive all new episodes. In addition, we invite you to visit us online at McGuireSponsel.com, Let's Talk Tax podcast, to see today's show notes, technical resources, and links to more about today's content.